So here we have another example of calculating the income tax based upon a family where the couple is married filing jointly and they have 3 children, okay? Their gross income $95,000, adjustments are $12,000, deductions, we've got a list of them here, and a tax credit in this case as well, okay? So lots of stuff to consider as we go through the calculation. So first thing we want to do, and of course we can find the AGI, the taxable income, the tax calculation, the income tax, all this stuff based upon this information and the table that we'll be working with. So first of all, the AGI. So AGI, of course, is equal to the income, which is a $95,000 minus the adjustments, which are $12,000. So we've got $95,000 minus the $12,000 in adjustments, and that's of course like your retirement funds and stuff where money is pulled right out of your check or your check, right out of your paychecks to fund that. That would be what, $83,000 is going to be the adjusted gross income. Right, so then after the AGI, we'll get the tax income using that AGI. So we take the 83,000 and we're going to subtract off the total of the exemptions and deductions. So let's look at the exemptions first. According to our table, the exemptions are going to be $4,050 per person. And of course, there are 5 people in this family, right? 5 dependents total. You get the married couple filing jointly and the 3 children. So that's 5 total people. So what we need there is 5 multiplied by the 4,050 from the table. And that amount, 5 times 4050 is $20,250. All right, we'll get rid of the table now. So that's $20,250, and then we also need the deductions. The deductions, of course, you could do one of 2 things. You could take the standard deduction or the itemized deduction. Let's put the table back in. The standard deduction for a married couple filing jointly is $12,600, okay? So if this is greater than 12,600, then we're going to go with the itemized. And in this case, it's going to be because, well, yeah, just the 8 and the 5 together make 13,000. So we've surpassed that, plus we've got a couple other things to factor in. So definitely going to be doing the itemized deduction here. So now to make that calculation, we need to add all these together for the itemized deduction, but there's some very important details that I don't want to miss. First of all, the 8, 3, and 5 here, that's 16,000, right? So just in those top 3, that's $16,000. However, the medical expense is not covered by insurance. There's $8,000 there, but not all of that gets factored into the into your deductions. In fact, it's only the amount of this that surpasses 7.5% of your original AGI. Let me just double check and make sure of that before I commit and do the calculation. Yeah, 7.5% of adjusted gross income. So what we need to do is we take 7.5% of the AGI, and I'm going to do that in another color. So if you take, here's the AGI, if you multiply that by 0.075, that's 7.5%. 83,000 times 0.075, you get 6,225. Right, 6,225. So not all of the 8,000 is covered, just what is in excess of that value, okay? So if you take the 6225 off of the 8,000, 8,000 minus the 6225 is 1775. So really all that we can actually apply here is what did I say? $1,775, 1,775. And so when I combine that with the other 16,000, that's 17,775. And that's our deductions. 17,775. Okay? So that's these two numbers added together. Okay, so now I'm going to do that arithmetic quickly. The 20,250, 20,250 plus 17,775 is $38,025. And then I'm going to subtract that off of the 83,000. That gives me 44,975. So my taxable income is $44,975. Okay, so that should be the AGI minus the exemptions and deductions. Okay. All right, so that gets me pretty far down the line. Now my tax calculation is this taxable income. This is I'll call it TI, taxable income. And I got to do the rate from the table in stages. Okay, so here's the table. Okay, now again, we want the married filing jointly column. So you've got the single column, you've got the married filing separately column, and then you've got the married filing jointly column. So it's the third one over. And in that column, you've got multiple cells. The first cell takes off, the first $18,550 comes off and applies at a 10% rate. Then up to 75,300 gets the 15% rate. Now this number, the AGI, the taxable income, does not surpass that 75,300. So this couple is in the 15% tax bracket, and we only have to deal with two amounts here. Okay, so let's get rid of that table. And we're going to set this up again. And I'm going to just represent this. I like a visual, right? I like a picture here. So I've got this visual, and we've got two chunks. The whole thing from 0 down to 44,975 is the taxable income. The first chunk, which is the 18,000, and I need that value off the table, 550. That gets applied to a 10% income tax, okay? 18,550. The remainder, which we find by subtracting those two values, gets a 15% income tax applied to it, okay? So I need to take that 44,975 and subtract off the 18,550, and I get the remaining amount. So this is 44,975 minus the 18,550, and that would give me 26,425. That's the remaining portion of their taxable income that gets the 15%. And so from there, we're going to multiply the amount by the rate and then add them together to get our tax calculation, right? So this is using multiplication. 10% of 18,550 is 1,855, right? If I move the decimal one place over to the right, to the left. Here, the 15%, well, that one I'm not even going to try to do mentally. 0.15 times that $425 is $3,963.75. Okay, so now what we're going to do is add those two values together to get the tax calculation. So tax calculation is the sum of those, which is $39,663.75 plus $1,855 is $5,818.75. So that's our tax calculation. All right, now a lot of times we'd be done at this point. However, in this case, this couple has a tax credit of another $1,000. What's great about tax credits is they come off in their entirety, whereas adjustments, exemptions, and deductions only come off by the percentages that are applied. Okay, so not all of that money is taken off. Whereas here, this $1,000 is just taken off in a chunk at the end. And so to get the tax or the income tax itself, we're going to subtract off that extra $1,000 tax credit, and that will give us $4,818.75. Okay, so that's going to be the actual value of the income tax that this family owes at the end of the year. Now again, what's interesting here is that throughout the course of the year they've been having tax taken out of their paychecks, and if the amount that was taken out of their paychecks surpasses this amount, then they get a refund, which is really nice when that happens. If the amount that was taken out is less than this, then they have to pay in at the end of the year, which is of course an unpleasant surprise at the end of the year when that has to happen, but often it does. So anyway, this is the amount that this family would have to actually pay in, $4,818.75.